opening quote from Jesse Livermore about sitting tight is the focus of our video. This week saw significant gyrations in the market on concerns about Turkey, contagion in emerging markets, and an economic slowdown in China. When the headlines are blaring triple-digit losses in the Dow as fears of Turkish contagion spread, how do you know if you should sit tight? How do you make sure that sitting tight won't result in the same kind of losses you may have experienced in 2000 or 2008? We'll look at price for answers and talk about the benefits of a systematic approach to the markets. Before we look at how to know when to sit tight, we'll look at a summary of this week's economic data and interpretation. This week featured many readouts reflecting a strong economy. Housing remains a weak spot in the data. New housing permits were encouraging, as permitting is the earliest part of the housing pipeline. The XHB housing ETF is also showing signs of putting in a base. Business optimism reached the highest level since 1983 during the Reagan years, as business owners cite the benefits of regulatory relief and tax cuts. Overall, the economic data is reflective of a very strong economy. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. This week we're going to do something a little different. We're going to look at a 10-day, 1-hour chart. Later in the video, we'll be talking about the importance of looking at longer time frames, much longer than this. We can't manage a 10-year investment horizon on an hourly or daily chart, and this week's chart will show us something about sitting tight. All charts have what we call a hard right edge, where future price movement is unknown, and all we can do is determine probabilities. Last Friday, we crashed through a line of support and gapped down. Monday wasn't much better, and stocks declined 0.43% on fears of contagion from Turkey's currency crisis. On Tuesday, stocks rose as market participants shifted to the view that Turkey's crisis would be contained. We ran into overhead resistance as well. On Wednesday, the market declined significantly as the Chinese economy showed slowing growth and other emerging market countries showed spillover effects from Turkey. We'll stop right here at the hard right edge and ask questions about the future and what we're hearing on the news. The headlines are asking, what if the contagion spreads? What if we don't make it through January's high? What if this is a top in the market? What if global growth is slowing down? How long can the U.S. markets keep rising? Is global growth going to crash the market? Am I going to lose even more money tomorrow? And another question you're probably asking yourself is whether or not you should sit tight. A short-term chart can't answer these questions. Using charts with multiple time frames can answer the question about sitting tight, and we'll look at that later in the video. Now for the reveal on what happened at the close of the week. On Thursday, stocks rose on news of lower-level delegation trade talks between the U.S. and China, completely wiping out the day's previous losses, breaking through resistance, and pushing higher for the week. On Friday, stocks looked set to take a breather in the morning, but rose on news that President Trump and President Xi would meet for trade talks. For the week, we closed up 0.51%, and the month and year-to-date statistics are provided at lower right. Before we learn how to know when to sit tight, let's learn a little bit more about the man who coined this phrase. Jesse Livermore was born in 1877 and made his first trade in 1892 at the age of 15. In that day and time, there were bucket shops where anyone could walk in and trade small amounts of stock in-house rather than on an exchange. Bucket shops were notorious for defrauding their clients. Jesse Livermore turned the tables on bucket shops and developed expertise in identifying trending stocks. He gradually developed a price-based system of buying trending stocks, letting winners run, and selling losers quickly. This sounds a lot like long-term trend following. Mr. Livermore famously made $100 million shorting the market top in 1929 that led to the Great Depression. $100 million in 1929 would be the equivalent of $1.4 billion today. Over the course of his life, he made several fortunes and lost everything 3 times. Ironically, by not following the very rules he himself had formulated. His story and methods are told in the book Reminiscences of a Stock Operator that you see pictured at lower right. People often cite lessons for winning from Jesse Livermore, but the greatest lessons of the market are taught by losses. His most significant losses came from not trading systematically when he started, developing a system that worked in bucket shops with instant execution, and then disastrously trying to trade the same system with delayed execution on the New York Stock Exchange. He lost again by not trading systematically by acting on a tip and holding a loser based on expert advice. Profit or loss in a trade is determined by price. Every day, financial television brings in experts. One says buy and the other says sell. With such expert advice, you'll find price is the only expert you'll need. There's a lot we can learn about trend trading from Mr. Livermore's successes and failures. Trade on price, trade systematically, buy trending stocks and let winners run. Losers should be cut quickly. Never enter a trade without a stop. Without a stop, your potential losses are unlimited. You should always define your risk. Once you've entered a trade, sit tight. Price will either run and show you a winner or hit your stop for a small loss. Mr. Livermore never advocated sitting tight without an exit point. Sitting tight without a stop is called buy and hold. Buy and hold in 2000 and 2008 resulted in disastrous losses. To sit tight in long-term trend following, you must have a stop to keep losses small and make large gains in trending winners. We still don't have an answer to the question of how to know when to sit tight. Since we're long-term trend followers, we might be able to get at the answer with moving averages on charts covering multiple time frames. A bullish trend across time frames would look like this, and a bearish trend across time frames would look like this. We routinely cover this subject matter in our videos. If this material is unfamiliar to you, you can check out this video titled Caliber's Trend Following Strategy on YouTube. This approach allows you to easily visualize the trend and is easy to understand in a presentation. So why don't we just use moving averages instead of a model? Using moving averages introduces a delay which eats into our profits. We can use many other indicators to improve the model. Timeframe continuity is the concept of agreement of an indicator, such as a moving average, on multiple charts covering different time frames. So let's answer the question about whether or not to sit tight for both the start of the correction in 2018 and for the events of this week. Starting at the upper left is a daily chart of the S&P 500 ETF, or the SPY. Below that is a weekly chart. Each longer time frame will show the information from the daily chart condensed into a gold box. At upper right is a monthly chart, and on the lower right is a yearly chart. Here you see the start of the correction in 2018 and the bearish signal in the moving averages. The moving averages went from a bullish configuration with a positive slope with price largely above to negative slopes with price largely underneath. Did we sell any of our core positions, or did we sit tight? How did we know to sit tight? While this isn't our model-based approach, you could look at the weekly chart and see that the moving averages were still in an upward bullish trend. The monthly moving averages were also in an upward bullish trend, as were the yearly moving averages. The time frames you look at will be unique to your specific investment time horizon, and there is no way to know if the information in this video is suited to your investment objectives. How about the emerging markets crisis this week and fears of contagion? Here's what happened on the daily chart. How do we know whether or not to sit tight? Let's look at time frame continuity of the bullish trend across charts. We see the bullish trend on the daily chart, the weekly chart, the monthly chart, and the yearly chart. Since our approach is long-term trend following, the longer-term trend is bullish. We can tune out the frightening day-to-day headlines and focus on the facts on the charts. You don't need anyone else's expert opinion when you can see the trend with your own eyes. Let's look at timeframe continuity in the market top prior to the crash of 2008. Remember, moving averages lag too much to be used in our model this way, but are great for visualizing the trend. Starting with the daily chart, the first warning comes in August with a breach of the moving averages, followed by successive warnings with additional incursions into the moving averages. By December, the lagging moving averages give you a delayed signal, and price can't even close above the moving averages. Later and later, you get the same bearish signal on the weekly, monthly, and yearly charts. The bearish signal is continuous across all time frames. As signals begin to agree from the daily chart to longer and longer time frames, you would incrementally shift away from risk assets to defensive assets. When you can see the trend faster than shown by moving averages, you have a better answer to the question of whether or not to sit tight. Some of the worst words you'll ever hear concerning your money will come from well-meaning people who don't understand or follow trends. And after realizing large losses in your account, you'll hear the words, "Don't worry, it'll come back." The long-term bullish trend is intact, and we're sitting just below new all-time highs in the broader S&P 500 index. So as we sit tight, let's quickly walk through bullish progress out of the sell-off in early 2018. We didn't know what would happen when the sell-off began, so let's step through the chart that way, with a hard right edge where we can't see the future. If you watched the videos, we had to make investment decisions based on the probabilities. Remember, we could see the bullish trend was intact across multiple longer time frames. We had our sell-off in January and February, and once we made a higher low, the January high and the February low established a consolidation range. Over the next month, we put in a lower high and a lower low, allowing us to connect the peaks and lows in a symmetrical triangle pattern. In a long-term bullish trend, these patterns have a higher probability of being continuation patterns. In April, prices trended up, and we used the low of an outside bar for a new triangle. In May, we break out over the top of the symmetrical triangle in a bullish manner, and we come back to test the top of the triangle. In June, we have another retest and price advances. We form a new triangle reflecting the bullish price action. As price moves higher, we form a new triangle using the June high. In July, we break above this triangle, and price now forms an ascending triangle. This pattern has a high probability of breaking to the upside, and we do. We go on to break above the consolidation box and come back in, which is not at all unusual. A series of higher lows from the ascending triangle and a series of higher highs forms a bullish rising channel, bringing us to today where we're sitting just below highs. If you've been watching our videos, week after week you've seen us cover each of these patterns, state probable outcomes, and make our own investment decisions. This slide walks you through what we saw and how price played out. Again, while this is not our model-based approach, being able to visually observe patterns and determine probabilities is certainly a complement to using a model. Now let's look at a daily chart to determine the current probabilities. As always, they could change at any time, and we'll expect to see such change on the charts and look for confirmation from multiple time frames and other data points. It is not at all uncommon for price to re-enter a range after a breakout to the upside. Today, price broke above the prior resistance line from the January high, which we're changing back to green to represent support. Below is another line of support that previously defined a range. Will price stay above support this time or go back into the range again? Answering that question would be predicting. We look at probabilities, which include all possible outcomes, but we focus on the outcome with the highest probability. What else can we look at to determine the most probable outcome using just this chart? Price has been forming a series of higher and higher lows. Price has also been forming a series of higher and higher highs. Price retested a rising 50-day moving average and reclaimed it, and on this low couldn't quite reach the 50-day moving average before price advanced again, indicating that the trend is strengthening. The moving averages on this chart have positive upward slopes, indicating that the overall trend is bullish. A long-term bullish trend means that as we look forward to next week, we'll be sitting tight. We'll be ready for new highs or any other evidence the market gives us. As Jesse Livermore said, another lesson I learned early is there's nothing new in Wall Street. There can't be, because speculation is as old as the hills. This statement is just as true now as it was then. Why, you might ask? I'll leave you with the answer to that question and some additional words of wisdom from Jesse Livermore in our closing slides. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.